You're ready to get started on your new business. So what company structure is right for you? Now, as a small business startup, you're likely going to look at three scenarios for your business: the sole proprietorship, the LLC, and the S corporation. Sole proprietors are unincorporated businesses. They're also called independent contractors, consultants, or freelancers. There are no forms you need to fill out to start this type of business, although it's a good idea to open a separate checking account to keep track of expenses. If you have a partner or need some liability protections for your business, LLCs or limited liability corporations can be the way to go. An LLC is less formal and more flexible than a typical corporation. LLC's members cannot be found personally liable for company debts. Their assets are separate from the assets of the LLC. S corporations have features similar to a partnership but is an incorporated business. This provides a measure of legal and financial protection for the shareholders or owners. An S corp must have at least one shareholder and cannot have more than 100 shareholders. If any shareholder provides services to the business, the S corp must pay that shareholder a reasonable salary. Now, this salary is a separate payment from distributions of profits or losses. An S corp has total control over the amount of profits they can distribute or retain, and they can have an unlimited number of years with losses. So, how do each of these benefit you tax-wise? Well, if all you want is simple taxes, you'll want to start as a sole proprietor. All you have to do is fill out a Schedule C on your current 1040. This would be no different than you're probably doing now, except that your W-2 income would decrease and your Schedule C income would increase. Now, the tax advantage of an LLC is that taxation is based on a partnership model. Members are only required to pay taxes on their earnings once instead of paying both corporate and personal taxes. But unless you're running up big business debts or credit accounts, it might not even be necessary. An LLC with only a single partner is taxed like a sole proprietor. An S corp can be overkill when starting up and more expensive unless you expect to be earning much more money than you need to live on and wish to retain that money in the corporation. The bottom line, if you're just getting started, you can probably start out as a sole proprietorship and then decide later if you need to do an LLC or more.